Hello, good morning and welcome to Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, along with me is Hormaz Pataki as well. Hormaz, very good morning to you as well. But yesterday, what we saw in terms of a morning coming in, that run-up in the Nifty, today it's a bit of a different story. Muted day coming in terms of a performance. Nifty down almost 0.8%. Broader end managing to still perform well, right, Hormaz?
Yeah. Par for the course, right? You go up 950 points in a session. It's only fair that you give up some of it and take some profits off the table, and that's what's happening here. But still holding on to important levels on the downside is the index, and of course recovering slightly from the lows as well. There's around about a 70-point recovery from the lows now for the Nifty, 170 points lower for the index. The broader markets too, of course, more than the index, the focus has always been on specific stocks, be it earnings reactions, be it earnings that you're going to report today. Of course, it's a very earnings-heavy day. We have 4 Nifty results, a lot of broader market results as well. So it's an important day that you will have to watch out for going forward as well.
Absolutely important day to watch out for. Pharma today is trending in trading session as well after yesterday's executive order that came in last evening. Though it's still an open-ended order, we'll wait out for more clarity. But at least today what we're seeing is Nifty Pharma among the top sectoral gainers, as well as the Nifty PSU Bank. That's also a top sectoral gainer. Keep an eye out on that. On the flip side, Hormaz, we have IT that's not managing to hold on to gains. So that'll be something that we are watching out for, right?
IT also went up almost 6-7% in yesterday's session, so still giving off some of that. But the big story that we have been tracking over the last week and the upcoming developments as well, the India-Pakistan tensions have subsided over the last couple of days with no fresh reports of firing, shelling in areas of Jammu and Kashmir, Rajasthan or Gujarat. We are now being joined by Shireen Bhan to take this conversation forward. Shireen, couple of days of calm, but what are the latest developments that we are tracking so far?
Well, that is right. Another night of relative calm, Hormuz. But let me once again, for the benefit of our viewers, recap what we've seen happen. Now, there were reports coming in last night which were acknowledged by the Indian Armed Forces that there was drone sightings in Samba, which is near Jammu and Kashmir. Now, this happened post the Prime Minister's nation's address. But what the Indian Army had also said is that these were engaged and there was nothing to be worried about. So there was drones sighted in that region. They were engaged by the Indian Armed Forces, but post 10 p.m. we are given to understand that there was no further activity, so it could have perhaps been a message, so to speak, post the Prime Minister's address. But as a result of this, what has happened is that we've now seen airlines like Indigo, like Air India, issuing advisories saying that they have cancelled operations to airports like Jammu, Leh, Jodhpur, Amritsar, Bhuj, Jaipur, Chandigarh and Rajkot. Because obviously you don't want to be in a situation where you will be turning back and so on and so forth. There will be an assessment done of what is the threat perception at this point in time as far as civil aviation, civil airlines are concerned. And so a decision has been taken, at least for today, that there will be cancellation of operations by Indigo as well as Air India, and I would imagine other airlines as well, to these sectors. Now, just yesterday, we had seen the government remove that notice to airmen, or NOTAM as it's popularly called. 32 airports that were shut through the course of the week on account of the military operations were asked to reopen yesterday. We did see a resumption of services. Some flights did in fact take off and also land on their designated airports. But so there is no new NOTAM, i.e. these airports have not been asked to close. It is only airlines saying that they are cancelling certain flights to certain airports. We are also given to understand that there is a crucial meeting between the Civil Aviation Ministry and the airlines later today. So we will, of course, keep you updated on that. One of the other important aspects to focus on is that crucial meeting that took place between the Director General of Military Operations of India and Pakistan. Now, remember, that meeting finally took place at 5 o'clock in the evening. It was a scheduled meeting. It took place after the Indian government, the Prime Minister, had held a meeting with the armed forces, with the NSA, with the Defence Minister, etc. The Prime Minister's meeting took place in the morning. And this meeting, which was scheduled to happen at noon, was finally pushed to 5 p.m. and that meeting took place. Now, at the end of that meeting, what we are given to understand is that both sides came to an agreement that not a single shot will be fired by either side, that there would be no aggressive or inimical action by either side. But secondly, And more importantly, there was an agreement arrived at in that DGMO talk between India and Pakistan that there would be an immediate, in those words, immediate reduction of troops at the border as well as forward areas. So that is a significant development. We are going to have to see if that troop production has already started, whether it is underway. But as of 5 p.m, post the DGMO talks that took place between India and Pakistan, there was an agreement arrived at that there would be no further perpetration of any kind of violence, of any kind of drone activity, firing, shelling, any of that, and that there would be a reduction, immediate reduction of troops in the forward and border areas. So that's going to be something to watch out for as well. Now, let's come to the elephant in the room, and that is President Trump's latest set of comments, and there was plenty of them. And remember, Trump spoke ahead of the Prime Minister's address to the nation, one reiterating, which is in the usual Trump style, that the U.S. played the key role, the U.S. played the central role in the mediation between India and Pakistan. Trump going so far as to say that the U.S. averted a nuclear conflict between India and Pakistan. But what's important to note, and what's also worrying to note, is what he said post that. He said that one of the things that forced a cessation of military operations, forced a cessation of hostilities, in Trump's words, were trade. He said, we said stop, 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 or we will not do trade with either of you. Now, this is something that is being refuted by the Indian government sources that we've reached out to for a comment. Indian government sources telling us that there has been no mention of trade in any form or fashion in any conversation that took place between Indian officials and US officials. In fact, the Prime Minister reiterating what India has maintained so far, that the call for any conversation, dialogue, cessation of hostilities came from Pakistan. The Pakistan DGMO dialed his counterpart in India only when Pakistan realized that it wanted an escape route because of the offensive operations that India pushed forward, targeting air bases, targeting Pakistan's military infrastructure. This is what we heard from the tri-services as well as the Prime Minister in his address. Now, where does that leave us? President Trump also, in the same breath, saying that we're negotiating a trade deal with India, we're also going to be talking trade with Pakistan. Now, what's the logic for that, for instance, one may ask? When it comes to India, we all know the size of the Indian market, the size of the Indian economy, the fact that it is the fastest growing large economy at this point in time. And that is why the US is interested in doing a trade deal with India, because it wants market access. What is in it for the US to do a trade deal with Pakistan? It's an economy on the precipice. It's an economy that is at this point in time on a lifeline of bailouts from multilateral organizations, including the most recent bailout package that's been cleared by the IMF. So what is it that Trump is attempting to do when it comes to doing trade with Pakistan? Perhaps the obvious answer lies there in defense and defense equipment. And remember, what we have seen in evidence, even through the course of the past week, is the use of Chinese military equipment by Pakistan and by Pakistan's military establishment. So is that what President Trump is looking at this point in time? Pakistan, remember, does have the F-16s to start with. So this is going to be important to watch, whether any of this has any impact. It colors the current trade negotiations in any form or fashion. We'll have to wait to see. It's important, we've been speaking with experts who understand the nuancing of these things much better than you and I do. And Kaval Sibal, former diplomat, ambassador to many countries, was speaking with us yesterday, and he said that let's be mindful of not letting the US peace diplomacy or alleged peace diplomacy have an impact on the current trade negotiations. We are, of course, waiting for more details on the next round of talks between India and the US, and that is expected towards the later half of this month. But what's also important, and I go back again to what we've heard from people like Kapil Sibal, what we've heard from people like Shashi Tharoor, what we've heard from people like Jeffrey Sachs, is also to say that India must not put all of its eggs in the US basket. This is, as is very clear and evident, a transactional administration. I mean, we saw that yesterday with the manner in which the trade deal with China has been inked after calling China the biggest adversary of the U.S., a deal that's been done in Geneva between the U.S. and China. So we need to be mindful of how much to rely on the U.S. And what the red lines will be. So that's going to be crucial. But that's where things currently stand. Relative night of calm. DGMO agreement to halt any kind of military activity, as well as a reduction of troops in the border areas, in the forward areas, and of course civil aviation still impacted. There is no full-scale resumption of activities because of what transpired last night. We'll update you on the meeting that will take place with the Civil Aviation Minister and airlines. Back to you guys.
Thank you so much for that, Shireen, for rounding it up for us in terms of what has happened so far and what we're watching out for going forward as well. But on that note, we're going to slip into a very short break. Up next, we'll discuss what's buzzing in commodity space with Manisha Gupta, so don't go anywhere.
Welcome back, and 24,750 is where the index currently is, and some recovery from the lows of the day. Still, that recovery is now getting sold into a 200-point cut now on the Nifty 24,725. But of course, nothing alarming, especially considering the session that we had yesterday. On to commodities now, and Manisha Gupta is joining in today with gold losing a bit of luster. We put the spotlight on silver, Manisha.
Oh, well, yes, have to go with the gainer right now. But, you know, silver really seems slightly confused because yesterday, as the gold prices fell by 3%, silver also declined by 2%. But we saw the base metal prices doing well. And let's remember, because silver is part precious metal and part base metal, especially with more and more industrial uses now coming in for silver. With the strength in base metal prices, we have seen silver gain up by a percentage point and a half more today there. Well, also, when you look at the markets there, while we keep tom-tomming about gold on how it has gained 45% in last 12 months, I want to put limelight on silver as well, because it was in Feb 2024 that we seem to be meandering around that $23, $24 an ounce, but currently holding at around $33 an ounce and gaining above that as well. We have seen 45 to 48% of gains come in for silver as well in the last 14 months. And with the kind of numbers that we are looking at right now, where you have US-China trade agreement going through, so that would mean more silver demand from green energy, from photovoltaic, from solar as well. That could be supportive for silver. And silver also is on positive cues there, because the gold-silver ratio is still above 100, and that means perhaps some more profit taking in gold or some buying in silver. Also, when you look at the markets itself in sense of supply and demand, and there you can see it, this is the fifth straight year, 2025, that we are looking at a deficit in silver markets in the global markets therein, and that has to be supportive. The markets also are looking at strong supplies concerns coming in from Mexico and Peru as well, and that could lead to further gains.
Okay, Manisha, thank you so much for giving us the roundup in terms of what's happening in the world of commodities. But moving on, Bank of India recently reported their Q4 numbers. Interest income was flat. Net interest margins was up 3% sequentially. Meanwhile, the net profits nearly doubled on a year-on-year basis. We have Rajneesh Karnatak, Managing Director of and CEO at Bank of India, joining in with us to discuss their numbers as well as talk to us about the outlook for the bank going forward as well. Thank you so much, sir, and good morning for joining in with us on the show. What I want to start by talking about is in terms of the profits of the company. This time we know in Q4 mainly that was driven by recoveries. So I want to know in terms of what is the recovery pipeline looking like for FY26? What should we be expecting on that front?
Yeah, as regards the recovery is concerned, see, this year we have done a gross cash recovery of nearly 9,500 crores. This was against the backdrop of gross cash recoveries of around 7,800 crores in FY24. So very good recoveries we have done. In fact, we have been able to contain our fresh slippages also. So fresh slippages, if I tell, our slippage ratio has come down to 1.36% as against 1.53% as on FY24. So this year also, if I tell you our gross cash recovery internal management target, we have kept it around 11,000 crores on the cash recovery, which will help us overall improving our operating profit and net profit in FY26.
So 11,000 crores is what you are anticipating as recoveries in FY26. Mr. Karnataka, good morning. Thank you for joining in. But on the other side, sir, your yields, your NIMs are on a bit of a downtrend, and with the economy currently heading towards a lower interest rate scenario, what is the kind of margins that you are anticipating, A, for the first quarter and B, for the full year as well?
So our NIM is at 2.82% global NIM as on FY25, and it has come down by 15 basis point only on a YOY basis. Now, if you see our domestic NIM, it is at 3.10%, which is quite healthy. We have an international book of around 12%, because of which the overall global NIM was on the lower side, but domestic NIM is at healthy at 3.10%. With the kind of rate cut which has already happened, 25 basis point in February and another 25 basis which happened in the month of April by RBI on the repo side, there has been some pressure in margins. Without that, the transmission in deposit is yet to take place fully. The transmission would take another 6 to 7 months for the February and the April rate cut which is about to happen, which is there. So the NIMs will be under challenge in the first half of this current financial year, no doubt about that. But after it, it would stabilize and normalize.
Okay, so maybe first half, maybe we could expect some pressure on the NIMs, but later on, we are expecting that to stabilize going forward for the company. So, what about your CD ratio? Because that also has seen a slight bit of a dip in Q4 FY25. At what levels are you looking to maintain this? What should we be watching out for in terms of FY26?
So on the CD ratio, if you see, we have a very healthy CD ratio still of 40%. As you rightly said, it has come down from 43% to 40%. But nonetheless, we are one bank which has a CD ratio above 40%. Overall, if you see in the numbers, if I tell you the number on the CASA side, we have improved our CASA numbers from 2,69,000 crores to 2,80,000 crores. There is a YOY growth of 10,000 crore plus. As a strategy, we are very clear that on the domestic deposit side, we want to keep our bulk deposits within 14%. We are at somewhere around 13.8% only as on FY24, and majority of our domestic deposit will be either CASA deposit or retail term deposits, through which we will be able to contain our cost of deposits, which presently is also at a very healthy number of only 4.90%.
Mr. Karnataka, your credit costs have also gone up in the quarter gone by on a sequential basis. What are the credit cost trends looking like currently in this quarter, and what do you expect them to be for the full year as well?
So credit cost, if you see, in fact, it has come down from 0.78% in FY24 to 0.76% in FY25. On a YOY basis, it has come down by 2 basis points. So credit cost we will be able to contain in this financial year FY26, because we do not see much of fresh slippages happening. So slippages are also flat if you see FY24 and 25. That is why, in fact, the slippage ratio also has come down by nearly 20 basis points, and it has come down to 1.38% only in FY25. And this 7,500 crore of fresh slippage in FY26 is also contributed because of one large PSU account, which was nearly 1,000 crore. Had it not been there, our credit cost and our slippage ratio would have been far better. In spite of that, we have been able to bring down our gross NPA percentage to 3.27%, a reduction of nearly 171 basis point, and our net NNPA to 0.82%. And there also we had a good reduction of nearly 40 basis points. So this year our asset quality will be even better for FY26, both on gross NPA, net NPA, slippage ratio, and also the cost of credit.
Okay, better asset quality is what one could expect from the company in FY26. So, what about OPEX cost also? This time mainly sequentially, if I'm looking at it, mainly driven because of that staff expense, which has seen an increase. So going forward, are we expecting any further more rise going forward here? And what is behind the sharp increase this time as well?
So OPEX expenses overall, they are within control for us. And this staff expenses, which is a 12% YOY rise, is also because of the wage revision which happened, and certain PLI performance links incentive that we have to give in this financial year, we have fully provided in FY25 itself. If you see our cost to income ratio, that has improved. So in fact, our cost to income ratio in FY25 has now come down to 50.84%. In fact, it has on a YOY basis come down by nearly 22 basis points. So we are very much in control of that, and we are trying to control our controllable expenses so that the overall operating profit, which has this time has improved by nearly 17%, and our net profit, which has improved by on a YOY basis 45%, shows the same kind of growth trajectory in the FY26.
Well, clubbing two questions into one, Mr. Karnatak, you mentioned that slippages you're not expecting too many slippages this year. But when it comes to recoveries, you mentioned that there is an 11,000 crore rupee target. Do you see that coming in from the agri and MSME sectors where there were slightly higher slippages in the fourth quarter? And what about your write-offs as well? Because your write-offs were slightly higher in the fourth quarter as well. So do you expect that number to trend down as well?
So we have done very good recovery in the return of accounts. So if you see our numbers from the non-interest income, the recovery has been much better. In fact, we have a OTS scheme for recovery in the return of accounts. There we have given targets to our field functionaries where we are doing very good recovery, and this recovery goes straight away into the P&L through the non-interest income. That is the first part. So other part being whether we'll be able to do better recovery overall. As I said that yes, around 11,000 crore of cash cost recovery we are targeting for ourselves, and this year we have done a recovery to fresh slippage of nearly 1.25%, which was only 1.10% in FY24. So in FY26 we are targeting this number to be even better than that, and overall what we feel is that our asset quality will be much better in FY26 at the backdrop of good recoveries, less of slippages, and overall the ratios of gross and net NPA would be better.
Okay, sir, thank you so much for joining in with us, giving us an insight and light into what we should be expecting from the company in FY26 in terms of better asset quality coming in for Bank of India as well. Thank you so much for joining in with us this morning. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Apurva Sheth of Samco Securities and also discuss the top trading bets. Welcome back to Trading Hour on CNBC-TV18. We have Apurva Sheth of Samco Securities joining in with us to give us a quick check on the technicals on the market. Apurva, good morning. And in terms of levels that we are keeping an eye out on now for the Nifty as well as the Bank Nifty, yesterday surely was a run-up. Today is a bit of a profit booking. What are we watching out for there as well as in terms of your top bets?
So from the levels perspective, I think that Nifty is likely to trade in a range of 25,000 to 24,500. We have seen a sharp rally, and so there will be some consolidation, and now the action will shift towards small caps and mid caps. On the stocks front, we have Dr. Reddy's Laboratories. It has formed an inverse head and shoulder pattern. The numbers which it announced yesterday were good, and the volumes on the daily charts were also nice. So we would recommend Dr. Reddy's Laboratories with a stop loss of 1150 and target of 1350. And another stock is GSFC. It is forming a flag breakout pattern, and after a month of consolidation, it is now moving higher. So our stop loss will be 185 and our target will be 215.
All right, Apurva, thank you so much for sparing time and joining us with your views on the index and on specific stocks as well. By the way, just before we go into that break, Swiggy is now around 4% higher. It has 4% lower actually. It's recovered from the lows of the day. At one point was up down around 7% after its shareholder lock-in came to an end. So substantial recovery seen there in Swiggy off the lows of the day, now just 2.5% lower on the stock. Take a short break. On the other side, we get you a conversation with Kiran Mazumdar-Shaw from Biocon over the US President's decision of signing an executive order to cut drug prices in the US. Stay tuned. Welcome back. The recovery continuing on the Nifty from lower levels now, just 130 points lower for the benchmark index. It remains to be seen whether this recovery gets sold into or not, or do we see a sustained recovery as we go into the second half of the trading session, nearing levels of 24,800 now on the index. But speaking of some positive movers in today's session, Tanla Platforms is now up 9% as we speak. It's the top gainer on the Nifty 500, and some of the others as well, right? IIFL Finance is up 5% after the upgrade that came in from HSBC earlier in the day. So positive reaction to IIFL Finance as well. And some of the others, JM Financial is an earnings reaction. And of course, can't not talk about the defense names. They continue to move higher in today's session as well. Bharat Dynamics is now up 6%, the second best performer on the Nifty 500. Zen Technologies is up 4.5% as well. And some of the others besides the defense names include the likes of Reddington, that is also up 5.5% in today's session. But US President Donald Trump has signed an executive order giving drug makers 30 days to lower the prices of their medicines to align with what other countries pay. My colleague Ekta Batra spoke to Kiran Mazumdar-Shaw, the chairperson of the Biocon Group, and began by asking her about her views on this wide-reaching order. Listen in.
The discussion on reference pricing started in President Trump's first term. And he did introduce reference pricing at that time, but it was never carried through. And I think it's been very obvious that one of the ways of reducing healthcare costs through drug prices is through this price reduction. I think President Trump clearly called out the huge price differential between developed markets, especially Europe, and the US. And he asked why companies are adopting a dual price strategy when it comes to the US, where US is almost paying in some cases 50 or 80% higher than European countries. So I think that's his first target, where he wants to basically reduce this big disparity that he sees. And the second one that he called out is the middleman, which obviously refers to PBMs and wholesalers, who also, he believes, keeps drug pricing high for patients. So I think the approach that they're taking is not about tariffs, but about drug pricing. That's the way I look at it. As far as generics are concerned, as far as biosimilars are concerned, they are clearly being called out under the Affordable Care Act, and I don't think that's the target.
Okay, so you think that the steps under the executive order were basically limited to big pharma, innovative companies, and not really anything to do with the generic biosimilars as well as the generic drug space?
Absolutely. It was very clear from how he articulated his position on pharmaceuticals and drug pricing and bringing down the cost of drugs. It was clearly aimed at big pharma. In fact, RFK clearly said that although the pharma industry did sort of support his election campaign, our president cannot be bought. And he basically referred to the fact that they will do what's best for the American patients. So this is the way they are going about it.
Companies which have branded or specialty drugs in their portfolio in the US be impacted by this?
So it's largely, as you said, it is really the big pharma products, because if you know how the market is split, 80% of prescription drugs by volume only account for 20% of the value. And it's 20% of prescription drugs by volume account for 80% of value. And that's the 80% he wants to shrink.
For India, the kind of the drugs, the patented drugs that we do import or in license from branded pharma, are they going to get more expensive?
No, according to him, he believes that the drug companies price it at a lower price in the developing world, but he said he's not going to bother about the developing world prices because he said they need lower prices. But he said Europe doesn't need lower prices, is what his comments were.
Okay, so it's probably just going to be limited to Europe and Canada. That's where...
Yeah, the reference pricing is going to be limited to those countries.
All right. What might the impact be on CDMOs if big pharma companies look to actually reduce their cost of manufacturing? Do you think that they're probably going to get more business?
I think they will benefit because there are two sides to this. One is they want localization of manufacturing. On the other hand, drug companies will look at cost reduction to make up for the kind of dent that drug pricing in the US is going to make to their business. I think Roche already made a comment saying that they will have to rethink their investment in US manufacturing if this policy is carried through, because it would certainly impact their profitability and their ability to support investments in manufacturing. So I think there are already going to be some concerns that big pharma will express in this policy. So a lot remains to be seen. But personally, I believe that big pharma will have to look at ways of cost reduction, cost containment, and I think CDMOs, CRDMOs will benefit in India.
Okay. What will happen to R&D according to you if in case there is a change in terms of the structure and the pricing? Most of R&D is fueled by these high-priced innovative drugs. Is there going to be any kind of impact on R&D?
No, I think we actually provide a good, affordable cost option for R&D to be done in these parts of the world. I think that will benefit. I think they will actually invest more in contract research. And I think the drug manufacturing will go up to a phase 3 clinical trial, because I think they would largely like to then bring back large-scale manufacturing to the US, is the way I see it.
Okay.
And that's why I think Syngene also recently acquired a large biologics facility in Baltimore, because we see that they'll be quite happy, sourcing clinical supplies from outside the US. But, if the make in US strategy for novel products is going to be an important aspect, then I think you do need to manufacture the final product in the US.
Okay. On the other hand, we also have US and China, which are renegotiating their trade deal. Do you think that could be a spanner in the works for India's plan to become a +1 when it comes to CDMO and CRO manufacturing?
No, I think there will always be a balanced de-risking approach by all pharma, because, you can't depend on one geographic, area to do everything for you. So I think the +1 is always going to be a strategy followed by big pharma or anyone.
Okay. The US is going to, announce import tariffs on pharma in the next couple of weeks. What's your expectation, Ms. Shaw?
Again, I'm not so sure it will impact us. As you've seen, the US UK trade deal actually saw a soft landing for pharma. I'm hoping that it does the same for India. So we have to wait and see, but I don't expect it to be a major impact.
Are you looking at any kind of onshoring manufacturing in the US?
We've already invested in creating a manufacturing footprint in the US. We have a solid dosage plant in New Jersey. We have as I said, we just acquired a biologics facility in Baltimore. And we've just announced a very big insulin manufacturing partnership with Civica. So I think all these have been done with the aim of being closer to the market, closer to the patients. And of course, it also serves certain, regulatory aspects of supplying to certain US market segments.
Okay, on that note, we're going to slip into a very short break. Up next, we'll discuss the market fundamentals with Madan Goparamu from Sundaram Alternate Assets. So don't go anywhere.
What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Chennai Express actually was another film where, you know, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Welcome back, and it's time for the MSCI and their FTSE quarterly reviews as well, which will take place later in the month. Vivek is joining in with the list of expectations. Vivek, is Paytm set to make a comeback to the MSCI index?
Well, it appears so. So what we are basically tracking are the passive indices, like you mentioned, MSCI, FTSE, as well as Sensex. All of them will be going out and announcing a rejig as far as their constituents are concerned. So when you're talking about the MSCI, remember the rejig is the announcement is scheduled for May 14th. So tomorrow early morning is when we will be able to see the developments of the changes. So the likely inclusions, there are 3 expectations, and the source is IIFL Capital. Coromandel International could make its way. Inflow of close to over $200 million is what is anticipated. Nika as well as Paytm are expected to enter the MSCI Global Standard Index. On the other hand, Thermax could see an exclusion of close to, and there could be selling pressure of close to $126 million. Now coming to FTSE, the announcement date is on May 23rd. There are 5 likely inclusions as per IIFL Capital. Hyundai Motors, Vishal Megamart, recent listing NTPC Green Energy, Swiggy as well as Wari Energies are the ones that could see their entry as far as the FTSE indices are concerned. Hyundai Motors is likely to see the highest rate with inflows of close to $131 million. And lastly, remember, May 23rd, you will actually see the Sensex come ahead and announce whether there are any inclusions as well as exclusions, whether there is any rejig as far as the 30 constituents of the Sensex are concerned. IIFL Capital expects Bharat Electronics and Trent to come into the Sensex. So Bharat Electronics could see inflows of close to $275 million. Trent could see inflows of close to $278 million. And they could come in at the expense of Nestle as well as IndusInd Bank. Nestle could see outflows of close to $210 million, and IndusInd Bank could see outflows of close to $135 million. Very important to track, given the fact that there is quite a lot of passive funds as well as a few active funds that actually track this quite closely. MSCI is the one that will come the soonest, so that those are the stocks that are expected to react post the announcement.
Absolutely, Vivek. Thank you so much for that. We'll be keeping an eye out on those stocks in tomorrow's trading session. But on that note, let's bring on board Madan Gopal Ramu from Sundaram Alternate Assets, joining in with us to discuss market fundamentals and his top sectoral picks. Good morning, Madan. Thank you so much for joining in with us. Let's start by talking about the current scenario in terms of markets. For India, where we've seen FIIs selling for some time, now has started coming back. But there's a lot that is happening on the global front. Obviously, India, Pakistan issues were there last week as well. So that's something that everyone is keeping an eye out on. Do you think the FII flows will continue? Where do you see the market headed from here on now?
Yeah, hi. Good morning. We feel that with the recent correction that has happened in the market, particularly in the mid and small cap space from the peak of valuations, there are a lot of these manufacturing, capital goods segments, and even some of the financial names have become pretty attractive. And I think there is an interest coming back from the FIIs to buy into some of these names. So we feel that with FIIs being at the lowest level in the last decade in terms of their holding in India, I think there will be interest on every dip that can happen in India. So we are constructive on India from a medium-term perspective. are we constructive on the overall market at this point of time from index point of view? Probably not. We have seen a good recovery at this point of time post this noise around tariff war as well as the India-Pak war. I think the market has bounced back quite quickly. Probably at the overall index level, you will have to wait and see whether you will make big money in the medium term. But if you're going stock specific, I think a lot of opportunity got created in the last 3 months with the noise being around, and that's I think very important for you to create alpha, making use of those opportunities.
So where are those opportunities that you're finding, Madan Gopal? How are you positioning yourself, or how had you positioned yourself when the markets were at their lows, say around 21,900, 22,000, and now that you have seen a recovery of almost 3,000 points from those levels, how are you repositioning yourself?
While we continue to hold our structural calls in consumer and NBFC, we have repositioned some part of our holdings in e-commerce business, and then we deployed, and also some portion that we had in the renewable energy business where the valuations went a little higher. We got out of some of these positions and got into some of the financial space where the valuations became very attractive with the noise around the NPA cycle. We expect these noise to come off in the next 2-3 quarters. So we repositioned ourselves to get into some of this MFI related noise and the impact of that had in some of the stocks. We have to understand that when the markets is in a correction mode, and particularly there are additional short-term related noise levels increasing for certain companies, you can get really good value bargain in those markets. Obviously, you have to wait for these values to get realized in your holdings. At least it takes 1 to 2 year time period. But the opportunity that they are throwing, and if you give that time period for them, the alpha that these ideas can create for you is meaningful, and that's what we saw happening. So some of the financial calls that we took in the last 2-3 months, we expect that to create good alpha for the investors in the next year or so. Also, we got into some manufacturing companies where, again, in the period when markets were volatile and short-term news related to competition increasing in those spaces came off. These stocks where the earnings growth is very impressive. Even in the last quarter, I'm referring to some of the cable companies. The earnings growth in the last quarter was pretty impressive, and they are giving a reasonable guidance of growing around 20%. Valuations have become pretty moderate in these spaces, so we got into some of these names as well. So broadly, I would say we got out of some of the high valuation names in the e-commerce space, as well as some of the names in IT also, and we got into some of these manufacturing and financial space. IT actually we have come back and we have added back because the valuation correction was too steep in the last 2-3 months, and given the noise around the US slowdown, we could get some of these ideas back at a reasonable discount post exiting them, say 3 months back.
Right. So IT then also you're looking at, those mid and small cap IT names, or are you looking at large cap IT names? You've seen a correction coming in there, like you were mentioning. So which one are you picking?
Large caps, we are generally underweight for a long period on IT large cap, pharma large cap, consumption large cap, even banking large cap. We mostly look at those opportunities beyond the top 50 stocks. So in IT also, it's about mid-cap stocks where the growth is very impressive. When their valuations from the peak have come off, and given the growth guidance that these companies are giving from a medium-term perspective, and their ability to deliver it last year, despite weakness in the IT sector, gives us more confidence that a reasonable valuation, you should be going back to those segments rather than going to large caps. So I think large cap, I don't know whether you know this data, the largest sector loss in terms of weight in the Nifty 50 was IT sector in the last decade. And it will continue because IT sector large caps are not going to deliver a double-digit earnings growth for you, except for 1 or 2 years, probably if they get back some momentum in spending. So that's the reason I think mid-cap IT makes a lot of sense.
Okay, mid-cap IT makes a lot of sense. Also in just terms of, I want to understand, you were mentioning pharma as well. You're not looking at large cap pharma, but pharma as a sector, do you think CDMO players, that is something you will be looking at? What are you looking on the pharma side? Or you are avoiding it completely?
No, generic pharma is a avoid for us. I think again, a sector which is from a long-term perspective has delivered very low earnings growth, except for one or two stocks in the large cap who have done well. We are all talking about single-digit earnings growth for in the next 2-3 years also. But if you look at CDMO, that's a big opportunity, irrespective of what is happening on the trade war. It is this one sector where we saw clearly the China plus one story has been continuing to happen, right? You are seeing companies in this space continue to get orders. A lot of blockbuster drugs are going off patent slowly over the next 5-6 years time period. And also there are some new innovative drugs which are becoming larger. And see, these are very, very specific to those companies that we are talking about. We cannot make a very generalized statement, but CDMO is clearly a big opportunity. And given the de-risking that US companies want to do out of China, and also keeping in mind what yesterday's news flow from Mr. Trump on reducing the tariffs for the pharmas, generic pharma or branded drugs, both I think they will do something about it. I think outsourcing to India is going to get bigger and bigger, and particularly if you're acting in CDMO space, the opportunity can only become larger. So given the recent correction in these stocks that has seen in the last, say, 3 months, I think if you take a 2-year view and enter in them, you can make a decent amount of alpha from these ideas.
You know, Madan Gopal, you mentioned that you are looking at opportunities beyond the top 50 companies. Does the capital market names feature among them, or have they become so big that they've gone beyond the realm of the opportunities that you are looking for, be it the likes of BSE or CDSL, or even for the asset managers for that matter?
Yeah, so marketplaces are clearly double beta play on the market itself, right? So you actually make a lot of money by being in those stocks when the market itself is moving up or flows are very strong. I think some moderation will happen on both these counts. So really to go and be overweight on these ideas at this kind of valuation from a medium term perspective, you probably may not make big money. We had positions in some market players in last year. We have come out of those ideas now because valuation wise we found it difficult to convince ourselves, and given that market is getting into a moderation, the growth rates will come down, and therefore we may not continue to give such high valuation. So marketplace are out. We are putting more weights on the NBFC space within the financial space at this point.
Okay, Madan Gopal, thank you so much, for joining in with us this morning on the show, giving us an insight in terms of most of the sectors and what you're liking as well, and the markets. Thank you so much for that. But on that note, we're going to step into a very short break. We'll get you a look into what to expect from the fourth quarter numbers of Hero Motor, Tata Motors, Cipla. So stay tuned in.
Network 18 is now the clear leader in digital media, with 55% more users on native platforms and social media than Times Internet. Network 18, the undisputed leader of news networks, way ahead of the times.
Welcome back to Trading Hour on CNBC-TV18. Let's move on and talk about earnings that are expected to be reported today. We have Tata Motors in the list, and Sudarshan is joining in with us to tell us what the street is expecting. What should we watch out for this time? Good morning, Sudarshan.
Good morning. So Tata Motors is expected to report a muted set of earnings with volumes declining across the segments for both Tata Motors and JLR. And with these headline numbers, profit is seen falling 55%. Revenue, though, may increase by 3%. EBITDA may fall by 3%. And margin, too, can slip by almost 100 basis points and can come at 13.4% against 14.2%. As far as JLR is concerned, here profit may increase by 19%. Revenue, too, can increase by 2%, while EBITDA may fall by 5% and margin, too, can slip by almost 100 basis points. In commentary, we will be looking if after recent tariff decision by the US government and JLR again starting the shipment to the US, if there is any improvement in the demand in the US as well in the Chinese as well as for Chinese market. Also, if there is any guidance that company is looking to provide for.
Sudarshan is going to have a busy evening today. So since you already mentioned Tata Motors, tell us about Hero as well.
So amongst all the two-wheelers, Hero is the one company which likely to be reporting the weakest set of earnings, and here also it's because of the volumes that have declined both on a sequential basis as well as year on year. Here profit is seen rising 7%, revenue too can increase by 2%, but EBITDA might come flat at around rupees 1362 crore, and margin too can fall and can come at 14%. Volumes were down 1% year on year and down 6% sequentially, but the recent price hike that company had taken will support realization, and realization is seen rising 3% year on year and 1% sequentially. For Hero MotoCorp, we'll have to see how is the demand looking in the rural area, because it's the number one player if you take a look at 100cc and 125cc. So rural recovery, if there is any recovery, Hero MotoCorp would be the biggest beneficiary.
Okay, so Darshan, thank you so much for that. But let's move on. We have Ekta with us to tell us what to expect from Cipla in terms of their Q4 numbers. Good morning, Ekta.
Thanks for that. Well, for Cipla this quarter, we are expecting a revenue growth of around 9-odd%, the EBITDA to grow probably 20-odd%, with margins coming in at around 24% and a profit growth of around 13-odd%. US sales, watch out for that, expected to probably decline on a year-on-year basis. Now, domestic sales are expected to see around a 9 to 11% growth. Growth in the domestic business is expected to be led by the base business as well as Sanofi CNS portfolio. US sales expected to be around $218-odd million and could probably see a decline of 3 to 4% Q-on-Q, and could be probably impacted by issues such as lower sales of lanreotide impacted by supply challenges. Revlimid generic sales likely to be flattish, so estimates are around 54 to 55 versus $55 million the previous quarter. Margins, like I mentioned, should be between 23 to 24%. A couple of key things in terms of commentary would be, the update on lanreotide, albuterol sales, launch of Advair generic as well as a Brixon, and obviously all what is taking place in the larger world of pharma.
Indeed, promises to be a busy second half for all of us as the numbers start to trickle in. Ekta, thanks a lot for that. By the way, just as we mentioned numbers, you can't take your eyes off the defense stocks. Bharat Dynamics has now extended gains, is now up 7.5% as we speak. And some of the others as well, including the likes of Zen Technologies, BEL, those two are trading with gains of around 4 to 5% in today's session. Some flashes on your screen there. Lupin has launched the tolvaptan tablets in the US with 180-day exclusivity. We've been talking about this over the last couple of weeks. The tolvaptan tablets that are used to slow the kidney function decline in adults. It's an important drug for the stock, and so important developments coming in there.
A big opportunity for Lupin as well, because around 150 million to 200 million is what FY26 opportunity one is expecting, is what analysts had highlighted the last time we had this announcement.
And indeed,
as well.
So positive developments coming in for Lupin as well. So important pharma continues to be in focus, and their estimated annual sales in the US of around $1.5 billion. So it's a big drug for tolvaptan, for Lupin, and the stock now at the highest point of the day, 3.25% higher on that name as well. Among the losers, UPL continues to remain the top laggard on the Nifty 500, 5% down on that stock. KFin Technologies, after the block deal, has recovered from the lows, still down around 4%. And Bharti Hexacom, another broader market name reporting results today, is down around 3.5% ahead of its results. But KPR Mills too was down almost 10 to 12% in yesterday's session after its results, and it's extending its losses down another 3% in today's trade as well. But with that, we call time on this edition of Trading Hour. From Winnie, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.